My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do my friends. You know I'm just trying to make you a little money. My job is not just to entertain, but I'm putting this in context, explaining it. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. The great bear market continues, but you only know that if you're diversified away from tech. For days on end, stocks have been going down and down and down. Just not the great semi-softwares, data center companies with the wind at their backs, riding the tremendous themes of our time, accelerated computing and artificial intelligence. These tech plays are so strong that they end up buoying the averages, including today, which is why the tech-light Dow Jones Industrial Average actually dropped 26 points, while the S&P advanced 0.55%. A lot of that, the tech stuff, and the tech-heavy NASDAQ, filled with semis and software, gained 1.24%. And that's what people are looking at, even though you might not know it from the averages. Today was one of the worst days of what I'm starting to call the great selective bear market of 24-25. The bear has been roving around all sorts of areas, mauling the consumer staples, the energy sector, healthcare, the material stocks, all groups that have underperformed dramatically last year and doing it again. Now, understand the hyperbole here. I'm simply pointing out that these sectors, important swaths of the market, are an anchor to leeward. They spent last year hurting the market, and this year already, many are in the red. It's not just a continuation, people. It's actually an acceleration. Why is it happening? Why is the stock of Procter & Gamble down another 2.7% today? That's a great company. Why is Colgate toothpaste dog food? Why is Colgate down 2.9%? How about Clorox? It got pummeled. It's down 3.3% today alone. All right, so let's go over the reasons. One, maybe the biggest reason, someone would say, are interest rates. When long-term interest rates spike, as they've been doing ever since the Fed started cutting short rates, these stocks have been hammered. That's what happens. The dividends, by the way, are supposed to offer some protection, right? But they become a source of vulnerability when bond yields, the main competition in dividend stocks, keep marching higher. And they might do that all week because the long rates are rising thanks to supply. The Treasury Department sold 3-year notes today, and the auction fell flat on its face. Tomorrow, the Treasury sells 10-year paper. And Wednesday, I don't know if the market is prepped for 30-year paper, but there's a ton coming. As these bonds go down in price and up in yield, things get worse and worse for the dividend stocks, even if there's actually nothing wrong at the companies. Which brings me to the second reason this group has just been hammered. The dollar's gotten too strong. These consumer packaged goods companies tend to be very big overseas. That's not the case with Clorox, which is largely domestic. But you know how our stock market works. The consumer staples all trade together. If the dollar hurts a big international company like Procter & Gamble, as it is, it's going to reverberate even into a Clorox because they're all in the same sector. And sector ETFs are like gravity. They pull all their subjects down, even the ones that shouldn't. Now, then there's the most insidious problem of all, the one that no one is talking about. Let's open the discussion. Pricing. Now, have you noticed that when you buy consumer products on Amazon, they're discounting heavily, particularly the stuff you see at a drugstore? Have you seen the pressure being put on companies by Costco, where it's like a different world with those prices? They're crazy low. I know that Walgreens is trying to keep up, offering their own outrageously lower prices on their website, but you probably don't go to their website. Now, it is true that profitability may be pinched at some of these retailers, Walgreens, Dollar General, Dollar Tree, Target, all of which sell these goods, and they've all seen their stocks just get crushed. Walmart, Costco, and Amazon have more scale and can get you better prices for many daily average needs. But if the retailers are being squeezed, then their suppliers are definitely going to be squeezed too. Maybe these companies have had so much of a run, so much price flexibility post-COVID that they are finally losing it. Maybe the consumers had it, will no longer tolerate COVID-era high prices from the likes of a Procter or a Colgate. Maybe the stocks are saying prices will indeed be rolled back. Sell, sell, sell. Sell, sell, sell. The stock of Procter & Gamble is, it's tempting. It's tempting. But as long as bonds go down in price, as long as the dollar stays high or goes higher, and until we see the earnings find out if there really is some price pressure that I'm sensing, it's too risky to buy. Now, look at this counterintuitive situation. I know it sounds crazy to call Procter & Gamble and Clorox Colgate risky. These were safety stocks for most of my life, but there's nothing safe about their stocks anymore. This is a market that rewards growth regardless of price. So people will pay up for tech growth, which is all about real demand and pricing power, and they're avoiding companies that have lost pricing power and offer yields that are too low to compete with treasuries. I don't expect that dynamic to change anytime soon. Next bear market, oh my, it's in healthcare, as this group's off 20% from its highs. Next week, I'm going to the J.P. Morgan Healthcare Conference to find out what the heck is going on in this group, and I am aghast. These stocks are just hideous. Humana is down 43% from its highs. HCA, the hospital company, off 29%. That one's been a winner for years. Signal off 25%. Well run. Centene down 23%. A wasteland of burned-out companies. Look at the biotechs. Whoa, Vertex off 23% from its highs. That's a great company. Amgen, Dow stock down 25%. Regeneron, for heaven's sake. Biogen off huge. Moderna down a hideous 75%. Remember when they were strong? That are heinous now. Food Group just taking it on the chin. Hormel, great company, down 17% from its high. Smucker, General Mills, Conagra off 19%. Hershey, Campbell's, Kraft Heinz, and the Mondelez all down in the low 20s. That's incredible. Same script, higher rates, stronger dollar, pricing pressure. But let's throw in the GLP-1 weight loss drugs, too. We know these companies are loath to admit that GLP-1s have anything to do with their weakness. But that Cornell Business School study I referenced last week, it talked about a 6% decline in grocery spend for people who take drugs, the GLP-1 drugs. Processed foods are designed, in part, to be craved. But when you're getting these GLP-1 injections, you crave nothing. Maybe the sales decline is just beginning. Maybe that's what the stocks are saying. What else? Real estate, wasteland. Just today, we saw Federal Realty and Kimco's shopping center and a strip mall company get crushed. Worst stocks, two of the worst stocks in the S&P. Now, this is highly unusual. These companies are linked with interest rates, and the spike in long rates has all hurt them. But the actual businesses, they're terrific. It doesn't matter to the stocks, though. What matters is interest rates. Oh, hey, listen. As bad as those are, because I just said about rates, the bear has really mauled the housing stocks. The declines are staggering. Lennar, trading at 193 in September, it's down 135. Toll's going from 169 to 126. Pulte, 149 to 109. D.R. Horton, 199 to 139. And no time flat. What do you think it says? I think the home prices are going lower, maybe much lower, something that no one is thinking about. But nothing's as bad as the materials, mining, minerals. When you look at the stocks in this group, and I'm talking about plastic, I'm talking about wood, it's almost enough steel. It's almost enough. There's got to be something going on. If you didn't know any better, you think there's a recession. The chemicals, the papers, the coppers, the steels, they are factoring in a definite recession. No other way to explain the decline. How Nucor stock's down 41% from the top, Newmont Mining down 36%, Freeport, the copper company, down 30%. Cleveland Cliffs has plunged from $22 to $9. And how about the oils? They're all horrid, too. Which brings me to a thesis that's not talked about much when we see all these Federal Reserve officials telling us how inflation is not being brought to heel. It's true. There is plenty of inflation, particularly at the supermarket. But the bottom line, when you look at these super underperforming stocks, all I can say is maybe the Fed had better be careful for what it wishes for. Companies that represent a gigantic chunk of the real economy have seen their stocks swoon. Could their earnings be that far behind? And could inflation be running its course a lot faster than expected? Considering the stocks that are going down and the magnitude of the declines, I'll tell you, it sure wouldn't surprise me. I'm going to Frank in Texas. Frank.
Hey, Jim, a hearty Philadelphia Eagle booyah to you.
You bet. Let's hope that Hertz is okay, booyah. What's going on?
Well, first of all, a hearty thanks to you for all you've done for my wife and I. You made a major difference in our life. Thank you. Don't ever retire.
Yes. Well, I'll tell you, I think that my wife wants to hear that. She wants to hear people say that because I know that she feels like I'm a little long in the tooth, but I like being here. What's going on?
Well, Jim, I have a position in Netflix at a cost basis of $9.89 or $8.92, and I've been buying on dips, and I'm wondering if I should buy more, hold, or sell.
I'd buy more. I know the chart looks like it's rolling over. Maybe you wait till like 800, but I would buy more. I think that they are still the national water cooler stock. It's very unusual to have something like it. Look, spoiler alert, I just have to say this. My wife stopped watching mid-show the final Squid Games, and I just want to point that out because there are a lot of people who might be a little more sensitive. That's not a spoiler. It's just, I'm just saying she walked away. It's pretty dazzling. We watch everything together. Anyway, companies that represent major parts of the economy have seen their stocks swoon lately. The big question is whether their earnings will follow. On Mad Money tonight, what's behind the decline in some defense stocks? I'm taking a closer look at this cohort and how the incoming White House could affect the space people aren't talking. Then I'm bringing you another bull versus bear analyst duel. This time it's on Uber. I'll break down where I stand. And later, Cerence AI. Have you seen that crazy thing? It's already soaring higher in the new year. I'm going to check in with the CEO. You've seen him before to hear what's behind the big run-up. I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.